Hi everyone, good afternoon. Welcome to today's session. So, yeah, absolutely. Today we're going to be talking about all things loans. But just to briefly introduce myself first, for anyone who hasn't joined one of these webinars before, my name is Amy Staines and I'm the Senior Financial Education Manager at Better with Money. And Better with Money is an independent financial education company, and our aim really is to help bring money matters to life and hopefully, as a result, reduce any financial stress you might be feeling, as well as helping you to build upon your financial resilience as well. Now, just a couple of housekeeping points. So, first of all, the webinar is providing information only, so I won't be providing any sort of financial advice today. But I am aiming to give you the tools and knowledge of loans to help you really take control of your money. And it's also important to note that Better with Money isn't connected to any of the companies or the websites that I mentioned today. And we also have no financial products to sell. So, where I do mention companies or websites along the way, it's because we genuinely believe they offer really good services which you can take advantage of, rather than because we have any sort of financial incentive to do so. So, with that in mind, then let's get started and take a look at what we're going to be covering. And really, the aim of today's webinar is to help you better understand loans, whether you've got one already or whether you're thinking about your options. So, we're going to cover an introduction to loans firstly, before looking at the different types of loans out there and the loan application process. We're then going to look at credit scores and why they're important. And then we're going to finish with looking at how you can cut loan costs, and we will finish with time for Q&A. So let's set the scene then and think about what a loan actually is. And quite simply, a loan is a type of borrowing where you borrow money from a lender and you pay it back with interest over an agreed period of time. Now, loans are available from banks and other lending institutions, and when managed responsibly, they can be a great and useful way of really helping us to achieve our financial goals, and they can be a really normal part of managing our finances. Now, the key things really are borrowing from reputable providers, using any credit sensibly, understanding what costs are involved, budgeting to make monthly repayments, and also having a solid plan in place to pay off any loan by the end of the term. Now, in contrast, in cases where, for example, you're perhaps falling behind on repayments or haven't put that solid plan in place, that's where loan borrowing can start to negatively impact your financial health. So, this is really what we're hoping to look at and explore in more detail today. And there are various different types of loan, and we are going to look at lots of different types in more detail on the next slide. But two main categories of loan are secured and unsecured. So, secured loans. This is where lenders take something as security or collateral. So, for example, the loan might be secured against your home, or it might be secured against your car or jewelry or other assets. And in practical terms, where a loan is secured against an asset, then that lender could repossess that asset if you're in a situation where you can't pay back the loan. So, in that sense, secured loans are much less risky for the lender, and it can sometimes actually mean that you are able to borrow more money where a loan is secured. But if we compare this to an unsecured loan, so these might also be referred to as personal loans, which we'll see again on the next slide. But this is where you borrow money from a bank or other lender, you agree to make regular payments until that loan is repaid, along with any interest. And applications for unsecured loans are usually assessed based on things like your credit rating, the amount you're looking to borrow, because the lender will want the reassurance that you will be able to repay that loan, particularly as there is no collateral associated with it. But I do think it's important to finish this slide by saying that loans are only one way of borrowing money, and they might not always be the most appropriate form of borrowing to help you achieve a particular financial goal. So I have on this slide linked the Money Helper options for borrowing money tool, and this is a really fantastic place to start if you are still considering whether or not a loan is right for you, because it might actually help identify that there are other options out there which are more suited to your particular needs. So using this tool, you can see ways to borrow money up to £50,000. You can read the pros and cons for each option, and you can then decide which is the best option for you. But of course, there will probably be times where a loan is the best option for you. So let's take a look at some of the different types of loan out there. And we'll start with a mortgage because this is actually a loan secured against a property. And first mortgages are usually taken out when you buy a home, but you may also come across second mortgages as well. So where you borrow more money against your property, often with a different lender, over and above an existing mortgage on that property. And other loans secured against property include home equity and homeowner loans as well. But the next one on the slide is a student loan. So this does work quite differently to most other types of loan. And the type of student loan you have depends on when you went to university and also which country gave you the loan. So that is one of the first things to check. But in terms of how student loans are paid back, repayments generally only kick in when you start earning above a certain threshold. And even then, you will only repay a certain percentage of your earnings over that threshold. So it is for this reason that this is often likened more to a tax than a debt. But other differences include that student loans are deducted automatically from your salary when you get paid. The debt is generally cancelled after a certain period of time, and student loans taken out after 1988 also don't impact your credit score. So there are various differences that make student loans very different to other types of loan borrowing out there. But if we now look at car loans, and these can actually be secured or unsecured. So unsecured car loans are a type of personal loan taken out to fund the purchase of a new or used car. But other car loans might be secured against the vehicle. So in other words, that loan provider would be able to repossess the car in the event that you were unable to repay. But if we now move on to personal loans, which is we've obviously already mentioned, so a broad category of loan because these are those that aren't secured against an asset. So basically those unsecured loans that we spoke about on the last slide. And monthly repayments on personal loans are generally fixed to clear the debt in its entirety by the end of the term. And that term is usually between 1 and 5 years after you originally take the loan out. And the great thing about having fixed monthly payments is that it can really help with monthly budgeting because you know exactly how much it will cost. And we are going to talk about loan costs in more detail on the next slide. But before that, let's just finish off the two final points, starting with buy now, pay later, which has been cropping up all over the place more and more over the last few years. And buy now, pay later is often really easy to access and can simply seem like a really quick and easy way to pay for goods that you're buying online. But it is actually a credit agreement and a type of borrowing. So it's really important to know exactly what it is you're signing up to. Now, usually with buy now, pay later, if you are able to keep to your repayment plan, you may find that you aren't actually charged interest or other fees. But if you don't stick to that repayment plan, people do often find that charges can start to build up very quickly. So it's incredibly important to be aware of the risks and the terms and conditions associated with any buy now, pay later that you take out. And that's particularly true because these agreements aren't regulated in the same way as other consumer credit products. So you don't usually get the same warnings and you won't necessarily get the same consumer protection with these either. But the final point here is a payday loan. So these are short-term loans and are generally pretty expensive ways of borrowing money quickly particularly where you can't repay them on time and in full. So they're really designed to help you access money quickly, often to tide you over until your next payday, but they do charge very high rates of interest, so can become very expensive, particularly if you're taking longer to repay. And if you are struggling with short-term loans, do speak to the lender. So try to come up with alternative repayment plans rather than considering borrowing more money to pay an existing loan, because this is where they can start to become quite difficult to manage and may come out of control. But with all of these options, please also know that money lenders have to be authorised by the Financial Conduct Authority to lend money legally. And money lenders who aren't authorised by the FCA are actually breaking the law, and they are known as loan sharks. And so when you're taking out a loan, you might wish to check whether that money lender is authorised, and you can do that by checking the register on the Financial Conduct Authority website. But if we think about loan sharks, so these are individuals who often work from home, charge very high rates of interest, often don't give you very much paperwork to conform the arrangements they've made with you. And they often use lots of pushy tactics as well, and other illegal action to try and collect that money that they've lent to you. So we hear stories of, threatening violence, taking away credit cards or valuables as well. So it's worth being mindful of what a loan shark actually is. But please do be reassured that if you have borrowed money from someone who isn't FCA authorised, it's not you that's broken the law. It's them. And if you do find yourself in this sort of situation, please do contact the illegal money lending team. You can visit www.stoploansharks.co.uk. You can email reportaloanshark@stoploansharks.gov.uk, or you can call them as well on 0300 555 2222. So just worth being mindful of that, but there is a team out there to support you if you have perhaps come into contact with a loan shark. But if we turn back to legitimate legal loans, let's now look at the various costs associated with them, starting with the annual percentage rate, or APR. And this is the official rate that's used for borrowing. And APRs actually include two costs. So first of all, the cost of borrowing itself. So in other words, the amount of interest chargeable on that loan, which will be annotated as a percentage, but also it includes any associated fees, so including things like application fees or annual fees. So the APR gives you the total overall cost of a debt, not just the interest rate alone. And it's important to know this when comparing different loans or different types of credit from different providers, because any arrangement fees will be included in this APR figure. So actually, if you're just comparing the interest rate on its own, it actually might make a loan appear cheaper than it actually is, because it's not including all associated costs. So if you are making comparisons between loans and providers, do consider using that APR figure. But the next point here is another important one to be aware of, because you might not actually be able to access the advertised APR associated with a particular loan. And that's because many lenders use what's known as a representative APR. So this is an advertised rate that at least 51% of those accepted for that particular loan must get. But of course, that does mean that almost half of people don't actually get this rate and will therefore end up paying more. And you often won't actually know this until after you've applied. And so this is one of the reasons that it's really important to use an eligibility checker before applying. And we are going to talk about that more on the next slide. But the next point when thinking about costs are those relating to overpayment and early repayment of the loan. And you should be aware if fees do apply, particularly if there's a chance that you'll want to repay that loan early. And in general, loan providers must allow you to pay back personal loans early, or at least make partial overpayments. And actually, if you have cash savings, it often does make sense to do this, because it's highly likely that cash savings are attracting lower savings rates compared to the interest you'd be paying on a loan. But you should know that you may have to pay an early repayment charge if you are paying back more than £8,000 per year. And the level of that early repayment charge will vary. So do check out your individual loan agreement to find out what this would be. But it is often around 1 or 2 months interest. And these charges can sometimes actually eclipse the interest savings that you would make by repaying that loan early. So do crunch those numbers and do check that it does make financial sense to overpay or repay early. But if you can make larger payments, it can be sensible in some cases, particularly where we consider the concept of compound interest, because compound interest is where interest accumulates on existing interest. So, something to be really aware of with loans, particularly when considering the time you're borrowing for, because the longer you borrow for, the more that compound interest will accumulate, and so the quicker that debt will grow as a result. But with all of these, you might want to use a loan calculator like the Money Helper one that you can access through the Better with Money website, because this can really help to identify how much a loan will cost you and how quickly you might be able to pay off existing loans, particularly if you are able to overpay. And I would just like to finish off this slide by saying that if, when you are looking at the costs associated with loans, you do feel that you might struggle to pay, then please do think twice about taking out a loan in the first place. But let's look at the end-to-end process for applying for loans and the steps you should take. And as we've already mentioned, this does start with identifying how much you need to borrow and indeed whether a loan is right for you. So I've linked here the Money Helper tool that was on the first slide. So as we know, this goes through the different options for borrowing money because, as we know, loans aren't the only option, and actually a credit card or other type of borrowing might be more appropriate depending on how much you're looking to borrow, what that borrowing is for, and how long you need those funds for as well. But once you have identified that a loan is right for you, you should then complete your budget because it's really important to be confident that you can afford the monthly loan payments, and you should have that solid plan in place for paying off the loan. And this can be a brilliant opportunity to review your broader budget as well, because budgeting is very much an ongoing and dynamic process. And there are budget planners on the Better with Money website under the employee resources section to help you with this. But now the next thing you should know is that you will need to pass a credit check as part of the loan application process, because banks and other lenders will use your credit record to find out more about you as a borrower. So they want to find out how well you've managed credit in the past, how responsible you are when it comes to borrowing money. So they'll look at things like whether you pay your bills on time, whether you've made previous debt repayments on time, including credit cards. They'll want to know whether you've ever missed a payment and how much credit you have as well, because these past credit behaviours do provide an indicator for how well you're going to manage new credit in the future. So we will talk about credit scores more on the next slide, but do remember that a credit check will form part of the process. But once you've checked your credit score, you can then start comparing the loan options out there. And the Money Saving Expert website is fantastic for this. And part of this means completing an eligibility checker to give you an idea of the odds of being accepted for a particular personal loan. And it is, again, important from that credit score perspective, because if you are formally rejected for credit, this can itself negatively impact on your score. So you should have a good idea that you will be accepted before you apply. And eligibility checkers do only generally do a soft search on your credit record. So this won't show up to prospective lenders, but it does help indicate your chances of acceptance before applying. So do visit that Money Saving Expert eligibility checker that I've linked on the slide there. But once you've got that good idea that you are going to be accepted, that's when you can submit your application to that lender, and hopefully they will approve that loan. And sometimes it can all happen very quickly from here, with some lenders actually being able to make that money available to you on the same day. But I do think it's important to say here that taking out a loan certainly isn't a decision that should be taken lightly, given that it is a legally binding financial agreement. But it is worth knowing that there is actually scope to change your mind. So you will get 14 days from either the date you sign the loan agreement or the date you receive a copy of the agreement, whichever is later, and that's 14 days in which to cancel. So you might hear this referred to as a cooling off period, and it does apply to all credit agreements made in person, online, and over the phone as well. But of course, if you do cancel, you won't be able to keep those loan monies, and you will then have up to 30 days to repay that money, but you may still be charged interest for the period that you did actually hold that money. But just do know that you do have the right to change your mind. But where you are happy with the loan, then do try to repay it as quickly as you can within the constraints of any early repayment charges that we've already spoken about, and definitely making sure you're making all of those contractual payments on time and in full. Because typically, the quicker you can pay off a personal loan, the cheaper the overall cost of borrowing because you will pay less in interest. But let's just look at credit scores because obviously we've said that a lender will complete a credit check as part of a loan application. So let's just spend a couple of minutes thinking about how you can make sure your credit score is as good as it can be. And the first thing sounds really simple, but keeping an eye on your credit score is a really important part of this. And if you haven't checked your credit score before, it is freely available through apps like Credit Karma, Experian, and ClearScore, and it doesn't affect your credit score to have one of these apps. It only takes a couple of minutes to sign up, and keeping an eye on your score regularly can help you identify any areas for improvement. It helps you start taking steps towards improving your credit score, and regular checks can also help identify any errors on your report, including where perhaps you've been a victim of fraud and perhaps someone has applied for, some type of credit using your name. But another important way of improving your credit score is paying your bills on time. This includes everything from electricity and mobile phone bills to credit card bills as well, because paying bills on time shows prospective lenders that you are responsible and you do manage your money well. You appear far more trustworthy, and you might want to set up direct debits to help with this. So help with paying those bills on time because that money is taken automatically. So that reduces the chance that you will forget to make a payment. And it is worth noting that if you do miss a payment, it will stay on your credit file for 6 years and it could reduce your credit score by as much as 35%. But another thing that can help improve your credit score is actually having a credit card and using it well. And it might sound quite counterintuitive, but actually using a credit score builds up that responsible borrowing history. And it builds up that picture of you as a responsible borrower. Now, this isn't to say that you should go and get a credit card and use it to buy lots of things that you don't need. But actually, if you're going to buy something anyway and you have the cash to pay that off, then actually using a credit card can help you start building up that score. But if you do have credit, do be mindful of how much you're using because lenders do prefer to see that you're not using too much of the credit limit available because that can sometimes suggest that you're perhaps too reliant on credit, perhaps living beyond your means. So using less of your credit limit does show that you're managing credit well, and you will get a better score if you use less than 25% of the credit limit available. So, for example, if you have a credit card with a limit of £1,000, try to use no more than £250 of that. But other ways to improve your credit score include registering to vote, so making sure you're on the electoral roll of the property you're living in, and also having a long-standing bank account helps as well. So just to finish this slide, if you haven't already, do think about downloading one of these free apps. As I said, some of these will provide insights into specific things you can do to help improve your score. And we know that the better your score, the more loan options you will likely have available to you. But let's now move on to finish off by looking at what you can do to cut loan costs if you do have an existing personal unsecured loan already, because you may be able to find a better deal elsewhere. And this may be the case, especially if perhaps your credit rating previously meant you had to take out a high interest rate on that loan in the past, but have since seen your credit score improve. Now, I should just make it clear that cutting the cost of secured loans can be more complex. So this does focus on unsecured loans. But the first stage is reminding yourself of the terms and conditions of any existing loan you have. So working out if there are any early repayment penalties and finding out how much you would need to borrow on a new loan to clear the existing one. So that does include those early repayment charges. And where early repayment charges do exist, it might not actually be possible to make significant savings by switching loans. But if there are no or low early repayment charges, that's where you might want to look into this further. But it's then a case of completing another eligibility checker to understand the loans that might be available to you based on your current circumstances. And again, the Money Saving Expert website that I've linked on the slide has a really great eligibility checker. And it also has some fantastic comparison tables of different loans available at different levels of borrowing. So do take a look on there because it will allow you to compare the different loan options, compare the associated costs, and help you understand if you are able to save money through switching. And that loan switching calculator on the website will show you exactly that. So if you can save money by doing this exercise, and if you find you can, that's when you can go on to apply. But I do just want to finish off highlighting some of the places you can go for help and support, because as we know, loans are a form of borrowing, and from experience, we at Better with Money know that people of any age in many different circumstances and earning any salary can find themselves in difficulty when it comes to debt and loans. So if you are struggling, do know that there are people out there to support you. You can turn to the ICE Benevolent Fund or the Support Network. So these provide, confidential debt and budgeting advice on how to manage your debt and finances. And they offer fantastic support to help your overall broader well-being as well. So do get in touch with these, no matter how big or small you think your problem might be. But if for any reason you don't want to approach the funds directly, then there are loads of external organisations as well. So non-profit debt counselling organisations like Step Change, Citizens Advice and National Debtline, all with qualified debt advisors, and it's their job to help you. And as I say, they provide their services for free. So do reach out to them if they might help. But we've got a couple of minutes left for questions. So Fiona, I'll hand back over to you.
Brilliant. Thank you, Amy. Yes, we've had a few. One of the questions we've had is it better to get a second loan or extend/increase an already existing loan?
So good question. And the answer will be different for different people, but perhaps I can just shed a bit of light by distinguishing between the two options. So, if you already have a loan, but you need additional borrowing, you can either look to top up your existing loan or take out a new loan. So, with topping up, your existing loan would increase and you would generally maintain a single monthly payment. And if your existing loan is to be repaid over a new extended term as part of this process, then it's important to know that the total amount you're paying on that loan might increase as well. Now, whether or not you can actually extend or top up an existing loan will depend on the particular lender, and it will also usually depend on how long you've had that loan for as well. So some lenders, for example, might not offer this as an option, or they might only offer it after you've held the original loan for a certain period of time. So 12 months, for example, because that's when you've started to build up that track record of making monthly payments. But in any case, if you do this, a new larger loan will replace the old smaller loan. Now, the other option is that you might want to keep your existing loan as it is and apply for a separate loan entirely. So you have two loans with two monthly payments. And really, there are various factors to consider when choosing between these two options. So, for example, a top-up loan might benefit you if the new rate is actually lower than the existing rate on the current loan. And also, your current lender does already know you, which may speed up the application process. But with both options, you will probably go through another credit check. And so you should be mindful of all those things we've spoken about today when it comes to things like credit scores and affordability as well.
That's great. Thank you. I think we've got time for just one more question. I have a joint loan with an ex-partner who is refusing to help pay it off. Do I have options other than paying it off in full myself?
So the first thing I'd say here is that it's great that you're asking the question, and it's really important to tackle this head on. So with joint loans, often you will both be liable to repay the whole amount. So if your ex-partner doesn't pay their share, then it may fall to you to make all of those payments, because from a lender's perspective, they just want one of you to be paying that loan. Now, it does happen where you're perhaps not able to come to an agreement with your partner around how that debt should be managed. And so it's then really important to contact your bank or lender as soon as you can and have this conversation with them. So explain the situation. It's often worth putting a note on the account to make sure your ex-partner isn't able to, say, run up any further debts on that account. So definitely consider doing that and making that point clear. But as I say, do also take the opportunity to speak to your lender to see if there are any sort of agreements or arrangements you can come to directly with them to help you work through this situation. So, again, there's not necessarily one solution for this, but definitely speak to your lender because they will most likely have come across something similar before and will hopefully be able to help support you through what can be, a really challenging time anyway, aside from when there are kind of financial commitments involved jointly.